and welcome to the latest video with Money to the Masses. I'm going to be asking Damien lots of questions about different investment terms to help you who, if you currently invest, understand the terms in a bit more detail, or if you are thinking about beginning investing, have a better and clearer understanding of what all of these terms mean. So to get started, Damien, what is the difference between active and passive investing?
Active and passive investing is, one way to think about it is that a passive investment is typically run by a machine, and an active one is normally run by a human. And the active way of investing is normally something that is much more driven by a viewpoint or a process. So you may have heard of stock markets. So a stock market out there would be, a famous one would be the FTSE 100 in the UK, which is the index of the 100 biggest companies by market cap. So that is an index, they would call that. So that is tracked during the day, it goes up and down. If you were a passive investor, you may invest in a fund or a passive instrument, could be an ETF, that just literally tracks that index, what it does. So it gives you a general sense of the market going up and down. So you're just following the general up and down of the market, not a particular company. You're not following an individual share or stock, or like I say, a particular company's fortune. It's the overall feeling of how well the market's doing. And you can do that by doing something that is called passive investing. So a algorithm, a machine effectively just buys the shares of each company in the same proportion that that index has. And then you just put some money into that passive instrument, that passive fund. So what you're really doing is you're just riding the wave of the general stock market without having any overly strong conviction about an individual company. That is passive. So you're just along for the ride. It's passive, as the name suggests. Now, active can be where you might have a fund manager, that be a person who decides that they want to invest in UK companies, but rather than buy the general wider stock market to represent the market as an overall entity like the FTSE 100, they may say, I think I can pick the companies that are going to outperform in the next few years. So they will pick just some of the companies. They might pick Lloyd's, or name any company that you might know. They might buy shares in them because they think they're good value. And so what they do is, rather than having all of the market, they might have a portion, but it's down to a conviction that they've got. And the active part is them meant to be actively trying to seek those different opportunities and trying to exploit them. The fact is that there's a big debate about which is best. They are two different styles. I don't think it's an either or, but over the long term, there's evidence to show that very few managers or people really ever outperform the market if they are active investors consistently. They very rarely do. Now, that's very different to saying that you could pick and choose the people who do from time to time. You could move your money from one active manager to another when they're doing well. But if you had one person and you back their conviction, most managers don't generally, in the long run, outperform the market. So that's why there's been a massive increase in the number of people investing passively. And the other big thing to bear in mind is that active investing is more expensive than passive, almost universally, because there is an algorithm, a machine that's very low cost. You're just replicating something rather than having to pay for a whole entity, humans, analysts, all these things and transactions, all this stuff that can be suddenly wrapped up and make it much more expensive. And as an investor, the biggest thing you can control is not the market, but its cost. And therefore, that's another reason why passive investing tends to have an advantage over active investing over the long term.
So could you give me some examples of passive investing products?
Okay, I'm saying products, I'm not recommending these, but it's just so you can get a feel and go and have a look at them. Now, there's a company out there called Vanguard, which is a specialist in a lot of passive types of funds that have lots of these trackers effectively. So go and look at Vanguard Investor as a platform. You can buy their ETFs and these passive investments. If you want to look at some of the robo-advisors out there. So these are companies who just specialise in having a number of portfolios which you just pick one of, and your money goes into that based upon your risk profile. So if you're somebody who likes to take more risk, you might get a higher risk portfolio. they tend to run using passive investments. So they'll get a whole load of these things. It may be they track the UK stock market with one passive investment and the American stock market with another, and it may be the European stock markets and even bond markets, and they mash them together to give you something nice and balanced, and you can buy that. So overall, even though it's a group of passive strategies, it is still a passive portfolio. It's low cost. So those types of companies are people like Nutmeg, Money Farm, Wealth Simple. We have actually reviewed all of these on moneytothemasses.com. So if you want to look at each, do go find the reviews.
Yep, so that's it for this week's video. Anything we have talked about in today's video, I will put a link to in the description below. So thanks so much for watching. Don't forget to subscribe to our YouTube channel and give us a thumbs up if you like what you see. Also follow us over on our social media. So our Facebook, Money to the Masses, our Instagram @Money to the Masses, and our Twitter @Money to the Masses with the number 2. We also have a community Facebook group where there is lots of discussion about personal finance. So head over there and request to join.